Tesla Inc., NASDAQ TSLA, is trading at 437.52 USD, down 1.05 or 0.24% today. This slight downward drift might look like noise to the casual observer, but if you look at the order flow, there is a very specific type of accumulation happening right under the surface. Most people are currently fixated on whether the latest delivery numbers met the whisper numbers, but the real development that the market hasn't fully priced in yet is the massive shift in how the energy storage division is starting to carry the weight of the entire company's valuation. While the automotive side of the house is locked in a brutal margin battle across Asia and Europe, the megapack deployments are hitting record highs with much cleaner margins. This creates a fascinating tension because the public expects Tesla to be a car company, but the reality is that the financial structure is beginning to look more like a utility and software conglomerate. When you look at Tesla stock today, the expectation among most retail investors on platforms like the Robinhood app or through SoFi Invest is that a price cut in China or a new incentive in the United States will be the primary driver of the next leg up. The general belief is that more cars on the road equals a higher stock price. However, the contrarian view that is gaining traction among institutional desks at Fidelity and those using the Interactive Brokers platform is that vehicle volume is becoming a secondary metric. The real reality is that the automotive business is now a customer acquisition tool for the software and energy ecosystem. If you were sitting there with a smart friend over coffee, you would explain that every Model Y sold today is essentially a hardware shell for a high-margin recurring revenue stream that hasn't even hit its peak yet. Recent price action has seen the stock bouncing around this 430 to 450 range for several sessions. We are seeing significant trading volume that suggests a tug-of-war between short-term traders and long-term asset managers. If you check the heat maps on the Fidelity trading platform or look at the flow on the Robinhood app, you can see that retail sentiment remains stubbornly bullish despite the recent 0.24% dip. Institutional activity, specifically from the likes of BlackRock and Vanguard, shows that they have been cautiously increasing their stakes in the last quarter of 2025 and into the first weeks of 2026. This institutional support provides a floor, but it also means the stock is heavily influenced by the broader macroeconomic pressures that affect all big tech names, including Nvidia stock and Apple stock. The broader market is currently weighing the impact of interest rate decisions and global trade tensions on the entire Magnificent Seven group. When investors look for investment help through services like Schwab Intelligent Portfolios or wealth management from Fidelity, they are often told to look at the relative strength of Tesla stock compared to the S&P 500. Right now, that strength is being tested. We are seeing a lot of self-investing activity where individuals are choosing to bypass the traditional mutual fund route to buy fractional shares of Tesla directly. This democratization of online investing has created a unique volatility profile for TSLA. On a day like today, where the movement is a mere 0.24% to the downside, the lack of a major catalyst suggests that the market is in a wait-and-see mode ahead of the next earnings call. If you were using a Fidelity brokerage account or Interactive Brokers trading tools, you might notice that the implied volatility for Tesla options is starting to creep up. This usually happens when the market anticipates a breakout or a breakdown from a consolidation pattern. The expectation is that the company will continue to dominate the electric vehicle market, but the reality is that competitors like BYD are providing a level of pressure that Tesla has never had to face before. This is why the focus is shifting toward the Cybercab and the Optimus robot projects. These are not just side projects, they are the future of the company's valuation. Investors who are doing their own online investing research on various investing sites are trying to model the potential revenue from a fleet of autonomous taxis, and the numbers are staggering, but the timeline remains the biggest risk factor. Tesla operates on a business model that is fundamentally different from Ford or General Motors. While traditional car companies focus on the sale and then perhaps some service revenue, Tesla is building an integrated ecosystem. They own the charging network, they write the software, and they produce the batteries. This vertical integration is what allows them to survive price wars that would bankrupt other manufacturers. When you look at your Fidelity mobile app or monitor your holdings through Robinhood Investments, you have to remember that you are betting on Elon Musk's ability to execute on multiple fronts simultaneously. The company has moved from being a niche luxury car maker to a mass market producer, and now it is trying to become an AI powerhouse. The history of the stock is a series of moments where people doubted the company could survive, only for it to prove them wrong. We saw this during the ramp-up of the Model 3, and we are seeing a version of it now with the Cybertruck and the Semi. However, the stakes are much higher now that the market cap is in the trillions. Large institutional holders who use Fidelity Wealth Management or have an individual brokerage account with Interactive Brokers are looking for more than just growth. They are looking for stability and predictable earnings. This is why the margin compression in the automotive sector has been such a point of contention. If the reality of the earnings continues to fall short of the high expectations set by the stock's valuation, we could see a period of prolonged stagnation. Comment below how many shares of Tesla stock you currently hold in your portfolio right now. I want to see if our audience is leaning more toward the long-term hold or if people are starting to take profits at these levels. It is also worth asking, do you think the current price of $437.52 represents a fair valuation for a company that is essentially a bet on the future of artificial intelligence? Looking at the future outlook, there are several catalysts on the horizon. The mass production of the 4680 battery cells is a major one. If Tesla can successfully scale this technology, it will significantly lower the cost of every vehicle they produce, giving them even more room to squeeze competitors. Then there is the expansion of the FSD software to other manufacturers. If Tesla can become the Windows or Android of the autonomous driving world, the revenue potential would dwarf their current car sales. This is the scenario that keeps the stock at such a high multiple compared to traditional auto stocks. Investors using SoFi Active Investing or looking for the best investing sites often compare Tesla to Nvidia stock because they are both seen as the primary winners of the AI expansion. However, the risks are just as significant as the opportunities. Regulatory hurdles for full autonomy are a constant shadow over the stock. Different regions have different rules, and a single high-profile accident could lead to a massive setback in the timeline for the robotaxi rollout. Additionally, the political landscape in 2026 is complex. Changes in subsidies for green energy or shifts in trade policy with China could have an immediate and drastic effect on the bottom line. This is why many people who use a Fidelity trading platform or Interactive Brokers account choose to hedge their positions with options. If we look at the current technical setup, the stock is trading near its moving averages, which suggests a point of equilibrium. The volume today is steady, not indicating a panic sell-off or a frantic buy-in. This suggests that the 0.24% dip is just the market breathing. For those who are into self-investing through a Robinhood cash management account or a SoFi trading platform, these quiet days are often the best time to reevaluate the thesis. Is the company still on track? Is the competition catching up too fast? Is the valuation supported by actual cash flow or just by the promise of what is to come? The reality of the situation is that Tesla is no longer a secret. It is one of the most widely held stocks in the world, included in almost every major ETF like Fidelity ETFs or various index funds available through online investing platforms. This means it moves with the tide of the overall market more than it used to. When capital flows out of tech, Tesla feels it. When there is a rally in growth stocks, Tesla is often the leader. This makes it a difficult stock for those who don't have a high tolerance for volatility. Those who use Schwab Intelligent Portfolios or a SoFi robo-advisor might have a smaller, more controlled exposure, while those with a Fidelity brokerage account might be more concentrated. The central insight we can take away from today's movement is that the market is currently in a state of high expectation, but also high skepticism. We expect Tesla to solve autonomy, we expect them to scale the humanoid robot, and we expect them to maintain their lead in the EV space. The reality is that these are incredibly difficult engineering and logistical challenges that don't always happen on a linear timeline. The stock price reflects the average of these two forces. At 437.52, the market is saying that it believes in the vision, but it wants to see the next set of hard data before it commits to a higher valuation. When you look back at where the company was just a few years ago, the progression is remarkable. They have gone from being on the edge of bankruptcy to being a cornerstone of the global economy. This is why so many people are drawn to online investment in this particular ticker. It represents a bet on a specific version of the future. Whether you are using Robinhood fractional shares to get your foot in the door, or you have a massive position in your Fidelity IRAs, the story is the same. You are participating in one of the most significant shifts in industrial history. To summarize, today's 0.24% decline to 437.52 is a minor fluctuation in a much larger narrative. The expectation is that Tesla will transition from a car company